officer training with the mortgage calculator. We're going to wait just a couple minutes here to get started. Let us go live on all the different platforms because we do stream this live on Facebook, YouTube, LinkedIn, and Instagram. So give us a moment here to go live. We did put the chat up on the screen, so feel free to drop a comment there in the chat as you tune in. We appreciate the comments there. Hope everybody is having a good evening. Great topic here for tonight. I see some more comments coming in. Appreciate it, everybody tuning in. We're just waiting a moment here to get started. Go ahead and drop a comment there. Appreciate that. All right. Okay, it looks like we're live on all the different platforms, so we'll go ahead and get it started. We're going to take the chat off the screen for now, but keep dropping comments there in the chat. Feel free to drop any questions as we go through the training as well in the chat. Great. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM and investment loans. And what we do every Tuesday and Wednesday evening at 7 p.m. Eastern time is this loan officer training. And we go through a different type of loan or different type of training for loan officers. Tonight, we are going to be talking about quoting and structuring fix and flip loans, one of our specialties here at the Mortgage Calculator that we love to do. So we're going to go through that in depth for you tonight. So our sales manager, Jose, with 28 years of experience as a loan officer and a realtor, expert on fix and flips as well, will go ahead and take us through it. So Jose, if you're ready, let's talk about quoting and structuring fix and flip loans.
Good evening, everybody. Thank you for joining us for tonight's training. Tonight's training is definitely one that will allow you to differentiate yourself from the masses of application takers out there, right? Fixed flip loans are all the rage. And those of you that are already working with the fixed flip borrowers, you know that the fixed flip loan is just the beginning of that process for that investor, right? That's the beginning. That's the onset. They got to flip it. They got to buy it, repair it, and then they flip it, where the flip is either going to be, they're going to sell it, or as is more commonplace right now with the great rental rates that we have, and with the prognosis for lowering of interest rates and further increasing of property values, a lot of these flippers are choosing to retain the property, fix and hold. So then part two of the operation is the loan, the end loan, refinancing, refinancing the investor out of the short-term bridge loan, which is what a fixed flip loan is. It's essentially a bridge loan, and then financing them into the end loan. So essentially, it would be a 2-for-1, right? And we get a lot of those, quite a few of those. And as a matter of fact, quite a few of our loans tend to be the flippers that are looking for the DSCR loan. Sometimes we don't get to them until they're looking to refinance out of the short-term bridge loan. Then they find us and they stick with us. It's awesome when we can find them in the beginning of the process, so that then we can help them out with all of the great fixed flip products that we have. It's very important to know what a fixed flip loan is and what it isn't, right? So let me get right into it right now. And we're going to get into that so that you know how to deal with the investors. So like I was mentioning, a fixed flip loan is a short-term bridge loan, right? Short term, we got it anywhere from 12 to 18 months, designed to help investors purchase and renovate a property, usually to sell it at a profit, but also to facilitate the repairs if the investor desires to keep it and refinance out of the fixed flip loan into a long-term loan. Reason being that these properties probably have issues that, property condition related issues that would not allow them to be financed with a quote unquote regular loan, whatever that loan type may be. Income type really has no bearing on this. This is more of, is the property complete or is it missing components, right? Your regular loan, other than a renovation loan like a 203K or a Fannie Mae home style, which are purchase loans for um, non investors. We do have a purchase loan for investors that has a renovation component, but that is not really meant for flipping out of it. It's not a short term loan. It's a regular loan that if you get out of it in less than a certain number of months, you're going to have an early payoff default type situation. So, fixed flip loan, short term bridge loans for investors only. It is not a renovation loan, like I just mentioned. It's not a renovation loan like the 203K or the Fannie Mae home style. And we can go loan amounts anywhere from $50,000 to $5 million. Now, where is the fixed flip loan, or should I say, how is it used? Well, typically it's going to be used for the purchase of the asset. If it's a purchase, it's going to be used for the purchase, where you're going to get a certain draw amount at purchase, depending on the experience level of the borrower and the profit in the deal. That amount down payment is going to be higher or lower. Um, we're looking at anywhere as high. I'll share the guidelines with you, but we can go up to 90% loan to cost and 100% of the renovation, right? But those have to be deals with amazing ARVs, after repaired value. And I'm going to get into those terms. Now, I had this slide more towards the end of the presentation, but actually I put it number 2 because it is that important. Is that important when you're structuring the deal too? Because in some cases, if you have a deal that's a little bit lower in profit, um, the conduit may decide to lend on it if you're keeping the property rather than selling it. And then you'd have to be able to show the exit strategy, that you have a viable exit strategy, right? So it's really important when you are helping the borrower upfront in structuring their fixed flip loan. Different things need to be considered, like make sure that your ARV is solid, right? Where's the market analysis, right? Hopefully the borrower has one. And a lot of times these borrowers work with local agents that provide to them all of the comps that they need. So ask for those comps. And if they don't have it, well, then that's a good opportunity to collaborate with the realtors from that area. Reach out to them and obviously introduce yourself. Opportunity to tell them that you're going to be working with them to send them pre-approved borrowers that they can work with at no cost to them, right? You're just referring so that you can get referrals, right? Give to receive. And at the same time, you're going to hit them up for the market analysis, right? Get them happy and then have them do a market analysis for you. I mean, that's a very low price to pay by any realtor to be able to hook up with a lender that's going to give them free referrals. Then on that exit strategy, you'll be discussing with your borrower, are they going to hold the property or are they going to sell it? Then if they're going to sell it, obviously you want to market rent for resale to make sure the value's there. If they're going to hold it, you want to market analysis, not just for value, but also for rental income, because you want to see what is your debt service coverage ratio. And as I say this, I do want to remind everybody out there, we have many different DSCR programs with no seasoning on title to get the appraised value versus the purchase price plus renovations. We have 3 month seasoning on title. We have 6 month seasoning options, and then obviously the very usual 12-month seasoning options. The ones that really excite the investors, though, are the no seasoning in 3 months, because if they get done with that project in 2-3 months, they don't have to wait 6 months plus to be able to refinance out of the loan. They can get out of that higher interest loan quicker and start generating income for their rental property. Then different ways to exit out of that property with that final end loan. Many different options: full doc, bank statement, P&L, 1099, DSCR. With the DSCR usually being the preferred option for our investors, due to the fact that our investors tend to have multiple properties, a lot of stuff going on in their tax returns with write-offs for repairs, right? They don't want to have to pay any more taxes than they have to. So those do tend to affect the bottom line with income. Hence, most of the time, the SCR is the preferred option for the exit strategy loan. So let's get into some investor terms and fixed flip guidelines. These are our own guidelines here at the Mortgage Calculator for our fix and flip program. So getting into some of the terms that I want you to understand. Recourse loan is a term thrown out there a lot, and that is a loan that is personally guaranteed by the borrower. All of these loans that we're going to be talking about here, these fixed flip option that we're talking about, are all recourse loans. They're personally guaranteed by whoever is on that loan. Non-recourse loan would mean it's not personally guaranteed, which is not the case on these. ARV equals after repaired value, which is the value after the renovations are complete. As is value is the value of the property in its current condition. Renovation value, or renovation budget, is the total cost to complete the repairs, including hard and soft costs. Soft costs are items like permits, repair reports, and tests, like soil compaction tests, and different architecture reports that they may have to give from the structure. And then your hard costs are your actual renovation expenses, labor, materials, etc. Right? And I do want you to note, in looking at our fix and flip guidelines here, where it states, we can go up to 90% of the purchase price. That's on the maximum loan to cost, right? It can include 90% of the purchase price and 100% of the rehab cost. Now, when you're looking at maximum loan to ARV, the finished value, that's 70%. And they're going to go with the lower of any of these figures, by the way. So if the 70% figure, 70% of ARV is lower than 90% of the purchase price plus 100% of the rehab costs, then there's going to be an adjustment there. Now, FICO score, really interesting here. There is not a hard stop on the minimum, which is great news, because we deal with conduits that are very strong in this sector, right? So hence, there's not any real minimum credit score, but if the score does drop below a 620, then they're going to require 12 months interest reserves, right? In other words, the full interest is going to be prepaid at closing. The minimum interest reserve that's going to be required is going to be 1 month. And remember, this is a very subjective underwriting process. They're going to look at it. They're going to analyze the experience level, the credit, the profit in the deal, and then they're going to come up with these terms. Terms anywhere from 12 to 18 months. We're talking here full recourse. And another real interesting component, all experience levels are considered, right? So we will fund you with zero experience, but what's going to happen is that there may be an adjustment downward in the leverage, right? But a lot of that is going to depend also on the ROI of the deal, the profit test. That is the income on these transactions, right? So minimum they're looking at is 30% return on investment on the deal. If you don't have this 30%, then you got to have a DSCR test, right, of at least 1.2, because you're going to keep, especially if you decide to keep the property, they want to make sure that you're going to be able to refinance out of the property. And then we have some loan closing guidance offered there. Notice they need a clean title, no exceptions to Schedule B permitted. And really important, all guarantors must sign the loan documents. Right? So that's a super important there. Now, let me talk about some potential issues that will result in either a hard stop or require additional docs to clear the issue, to clear the condition, right? So you got there the hard stops, right? Financial crimes on the background check, 85% initial loan to cost, uh, greater than 100% construction holdback renovation budget, greater than 70% ARLTV, right? Loan to value, after repaired loan to value, no owner occupied properties. They do not want exotic or unique properties in rural areas. They do rural is considered, but again, if it's double negative, like a super unique property in a rural area, they're not going to do that. And you got to note how they treat finder's fees, right? It's real important, because if the finder's fee, usually there's a percentage on their maximum, which is going to be in one of the next guidelines. But to keep an eye on that, because that sometimes is a deal killer. If it's a daisy wheel, like they like to call it, right? It's like one person is just selling the contract to another person, who may be selling the contract to another person. There is a limit on how much can be added on by those resellers. And then notice here, when I was talking about how important it is, the exit strategy states right here, real important, deals without a viable exit strategy, they're not going to be considered. In other words, it either has to be a profitable flip, or it has to be you're going to hold it and there's a viable DSCR option for you. And then we have here some scenarios in which you would have to get some letters of explanation to explain credit, and also some scenarios in which you'd have to get a letter of explanation due to some background hits. Like traffic issues, not a problem, never an issue. DUI, 2 or more times in your background, we need an LOE. Marijuana, I would assume that's possession of some type, 2 or more times, LOE. For a misdemeanor, always need an LOE. And for a felony, always need an LOE. But keep in mind, if it's a financial crime that comes up, that's a hard stop. So let's continue some additional issues that could occur, which could result in lower LTV. Now, foreign national borrower, only with eligible valid visa or green card and U.S. history. So a little tight there with the foreign nationals. Rural areas, they're just going to have a lower initial advance rate. The initial advance equals your down payment at the closing, quote unquote. So there's going to be an initial advance, but they should still be able to finance 100% of the rehab, but there's going to be a hit on the initial advance. And then we covered borrower background issues, heavy construction, high loan to cost. If you're at 85% loan to cost or higher, they go up to 90. Experienced borrowers, profitable flips or liquid properties only. And if it's a high ARLTV, capped at 70%. Right. So a couple other items here, but I'll let you all read the guidelines. But really interesting stuff on how they treat cash outs. Borrowers should have at least 15% skin in the game at all times. They're not going to cash out 100%. And then Mid-construction, we get some of those situations, right? Somebody's halfway through the project. Now they've run out of time. Now they got to refinance it. They'll do it, but you do have to get some additional verification items as noted here. And again, refinancing another hard money lender. They're not going to refinance all of it. The borrower must have at least 15% skin in the game at all times if you're refinancing another bridge loan. So now you got a little bit of context. So now what's really important is knowing about how to vet the borrower so that you can quote the deal, right? If you don't have all of the information that's listed on this questionnaire, you're probably not going to be able to price your loan out through the different pricers out there, right? Uh, Experience level, again, real important. Borrower experience with flips is the biggest factor, right? The less experience that they have, the lower the leverage. Sometimes, depending on the profit, lower profit deal, you may not be viable for a low experienced borrower, but would be viable with a more experienced borrower. In that case, if your borrower is hot and heavy for that property, probably the only solution if they have zero experience is to find a partner, right? They can find a partner, do it as a joint venture, and then use the experience level of that partner, right? The fact that they have no experience isn't really going to matter if the partner has experience. The profit from the deal is the income that is analyzed as the borrower's personal or business income has absolutely no impact on the underwriting of the file. So if you notice, borrower's personal income is not in the questionnaire. What's in the questionnaire is the ARV, the rehab budget, and the as is value, right? That's what's going to determine the income from this deal. And then the other questions that are on here is going to determine the experience level of the borrower and the viability or exit strategy, as estimated rents, property address, and stuff like that. So again, I mentioned credit, 620 minimum credit score preferred, right? But that's not the they'll look, we will look at stuff lower than a 620, and we will just note the extra interest reserve. In most cases will be 12 months that will be needed if you have less than 620. Borrower will definitely need to demonstrate enough assets to cover the down payment if it's a purchase, closing costs, and the reserve requirement. There is liquidity requirements that they put on borrowers in these cases because they don't want to be dealing with a borrower that they feel is going to run out of money and not be able to close simply because they may have underestimated the scope of the work, and now they've run out of money and they're 80% complete. Rather than have to refinance, the best thing to do for them would be to just hopefully have the extra money to cover it. That is why we like to make sure that the borrower has enough liquid assets to cover whatever reserve requirement is going to be determined for that deal. And it is deal specific, right? The lower the profit on the deal, the lower the experience level of the borrower, the higher the risk. That higher risk is going to be offset by additional liquidity reserve requirement. All property types are possible, but 1 to 4 units are the most common. But we do have options for fixed flip on multifamily and commercial properties as well. So, what are the items needed for the loan application? Now, actually, let me back up a second here. Just to let you know, once you do compile all the information necessary, at that point, you will go to the pricer, click on the link for the pricer for our loan officers, and input the information, pretty easy, and the pricer will analyze it according to the parameters that are set. It's usually some type of an Excel spreadsheet, and then, or some type of an Excel spreadsheet working in the background. You may not be actually looking at an Excel spreadsheet when you're doing it, but it's usually something like that going on in the background. And then you'll have a response, and that's going to be the leverage amount. But in order to get there, you have to have all of these items, the data, and understand exactly what you're compiling. Purpose of today, right? So now you have your pricer. Your pricer told you your borrower is great. There's a lot of profit in this deal. They're going 85%, right? So what do you need? You need driver's license, personal financial statement, tri-merge credit report, and a background check, a purchase contract if it's a purchase, or a closing statement to verify the purchase price if it's a refi, the borrower's track record, which is their level of experience, 3 latest bank statements. And if it is an LLC, you're going to need certificate of formation, operating agreement, and certificate of good standing if the entity is older than a year. If it is a corporation, you'll need the articles of incorporation, corporate bylaws, and certificate of good standing, again, if the entity is older than a year. The appraisal is ordered at submission. Keep in mind, these are not always your standard appraisal. It really depends. If there's construction work being done, which there typically is going to be on all of these fixed flip loans, then you order an ARV appraisal, right? ARV appraisal, very specific, and you're going to have to upload to the order the estimate with the scope of the work, because the appraiser needs to know exactly what's going to be done, because they're going to calculate the as-is value. They're going to then look at the renovation, and then they're going to find similar properties in similar condition, right? Renovated with like the new kitchen and bathrooms and whatever else that your subject has. And if they can't find comps, then they're going to adjust accordingly on the appraisal for condition adjustments if they can't find recently remodeled comps. As is appraisal is if there's no construction, even though, remember, this being a fixed flip, there's probably going to be construction. So an as is appraisal is probably not applicable. And if your borrower is mid construction, right? Well, then they're going to have to do the same ARV appraisal. However, it's going to have an as is addendum with the appraiser acknowledging the percentage of the work that has already been completed. So appraiser obviously is going to have the scope of the work because it's an ARV appraisal, but then they're going to have to comment on how much is left to do on that job. And these items all get turned in, reviewed by processing. And that's it, because I actually moved my last slide to my second slide, which was the exit strategy.
All right. I don't see any questions here. I guess I'll give it a second here. Anything you want to add, Nick?
One thing I was going to add, Jose, was for the low score, just make sure you take the scores of all the borrowers, right? Because a lot of times they'll use the higher score. So even if joint venture partner is only a small percentage, if they're willing to sign the papers, they'll typically put the loan in their name and use their credit score. So definitely collect all the borrowers' credit. And the low one might not be a deal killer if there is someone much higher that is willing to go on paper there.
All right. All right. Looks like we got a question. Do we have a form to use for the personal financial statement, or do we get one from the investor?
The investors usually have a personal financial statement, but that's a pretty basic form. The most important thing on those personal financial statements, besides is looking at their net worth, looking also properties that they own, money in the bank, stuff like that. But that's a pretty standard form.
All right. Oh, looks like we got another question here from Chris. If you want to bring it up on the screen, would it still be considered a fix and flip if no hold borrower already purchased at auction and wants to just rehab loan, or would they have to get a rehab loan? So, okay, you're saying they already bought it at an auction.
That's fine. That's a very common scenario for a fixed flip loan, right? Borrower bought it cash at the auction. Property needs work. This is basically a delayed finance fixed flip loan. There, obviously, the borrower wants to try to recoup as much of their cash that they dished out, and also wants 100% of the rehab finance. So this is just going to be a refinance loan, delayed finance, refinance loan, and you're going to run it through the whole pricer as well, and the system is going to kick out an ARV. That's not ARV, excuse me, the loan to cost that they will cover and let how much of the current debt will be able to be refinanced.
Yeah, they could be used for purchase and refinance. Just remember, the leverage is always going to be less on a refinance. So if you've failed or already got into the property over leveraged, it's a little harder to pencil those in because the leverage is going to be less if you're already in the property.
And as showed a minute ago in the guidelines, the guidelines do want the borrowers to have a little bit of skin in the game, right? So it's doubtful that they'll be able to refinance 100% of the debt. From what I was reading in the guidelines, looks like they'll refinance 85% of it and 100% of the renovations if everything checks out.
All right. I don't see any other questions. So I think we'll go ahead and wrap it up. But this was a good one. We actually have a couple trainings where we just talk about fix and flips in general and stuff too. So you can check those out. But good job here. Appreciate that. Thank you, everybody, for tuning in. Remember, we do this at 7 p.m. Eastern on Tuesdays and Wednesdays.
What I wanted to just emphasize here, because I know that sometimes the MLOs, haven't done these. They may get a little intimidated with a fixed flip. They're very easy to do. It's pretty basic steps you got to follow, which we outlined here. And if you do your upfront work, it's going to be a very easy loan. I mean, in some cases, they don't even need appraisals for some of the fixed flip options out there. So it's going to be an easy loan. The only time you're going to run into a problem, and what usually happens is that the ARV is wrong. The appraisal gets done and the ARV is $100,000 less than they thought it was. Well, then, like any other loan, you may have an issue, but don't be intimidated. These are very easy loans with basically no income being considered. Just the profit margin on the deal is the income. That's it.
All right. Thank you, everybody, for tuning in. Thank you, Jose. We will see you all next week, Tuesday, 7 p.m. Eastern, for the next episode of the Loan Officer Training with the Mortgage Calculator. Have a great night, everyone.